Hi, Sam Bick here. This post is part 4 of the series to develop an integrated three-statement financial model for Lucky Lemon Company. You can download the Excel spreadsheet at the link below. When you download it, you should use it in Excel. The formulas that I use do not work in Google Sheets. Lucky Lemon Company is in the business of selling lemons. We have an uncle and he wants to loan us money. He wants to loan us $100 and wants to be paid back over 18 months. He wants to be paid back principal and interest each month. Now, he's a bit of a Scrooge, and so he charges us interest at 12%, and that's 12% per year. Now, this uncle, he goes online, Googles an amortization calculator, and enters in $100, 12% interest to be paid back over 18 periods. And he sees that he wants $6.10 per period. He decides to loan us $100 in March of 2025, and we agree to these terms. So the first step in this process is to develop a debt schedule. The debt schedule will have information such as the amount of the loan, the term of the loan, the interest rate, and the month that the loan is provided. The debt schedule will then tell us each month how much principal is payable and how much interest is payable. So in the real world, there are different types of loans. There's loans which are interest only, and then you pay the principal at the end of the loan term. Or there's mortgage type loans where you pay interest and principal in each period, and at the end of the term you've fully paid off the loan. In this example, we'll be using the mortgage type of loan where there's a principal component and an interest component payable each period. So once the debt schedule is set up, we now have to link it to the three financial statements, and shortly I'll be showing you how this is done in the Excel spreadsheet that we have. But to recap what the linkages are between the debt schedule and the three financial statements, this is what they are. So the first is the interest expense, which is the cost of the loan, goes on to the income statement as interest expense just after operating income. The balance sheet is updated in the liability section with a short-term debt and long-term debt. So short-term debt is the debt or the principal payable within 12 months of the date of the balance sheet. And long-term debt is the principal payable for the period beyond 12 months from the date of the balance sheet. And then finally, the cash flow statement in the cash from financing section, the money or the cash received from the loan is recorded, and then the principal payments are recorded on the cash from financing section. Note that only the principal payments are recorded in the cash from financing section. The interest payments are captured in the cash flow statement via net income being the starting point in the cash from operations section. Let's now go to the financial statement in Excel, the financial statements in Excel that you can download at the link below. So here you see the debt schedule. We have the initial loan amount, $100, interest rate of 12%, term 18 months, initial month of the loan is March 2025. You can change the term, you can change the initial month, and these numbers here will adjust accordingly. And we saw that in the depreciation schedule that we created in the last video. Okay, so with these inputs, the outputs that we have on the debt schedule are cash received from the loan, so it's $100 in March. Then we have the outstanding balance is shown here. The interest payment and principal payment basically uses the Excel functions IPMT for the interest payment and PPMT for the principal payment. Then the total payment, just like a mortgage or an amortization schedule, you have the total payment being the same each month, which is $6.10. And as you see there, it goes for 18 months and then stops. So how is this debt schedule linked to the three financial statements? So the first thing is on the income statement, the interest expense is H133. So this interest expense line on the income statement comes from the interest payment here. So that's basically the update on the income statement. Then the update on the balance sheet is we have two new accounts here: short-term debt, long-term debt. And the short-term debt, as I mentioned, the short-term debt is the sum of the outstanding debt within the 12-month period from this balance sheet date. So in this period I'm showing here, the balance sheet date is the end of March 2025. So we go for 12 periods after that, sum up the debt, and then that is the short-term debt. And then the long-term debt is for the periods beyond the 12-month periods is the long-term debt. So short-term debt is the debt due within a year. Long-term debt is the debt due beyond a year. So that's the balance sheet update. And then finally, the cash flow statement. We have cash received from loan, $100. So we have two new accounts here: cash received from loan, $100, and then the debt payments. So no, this only includes the debt payments or the principal payments. You don't include any interest expense here. The interest expense is covered because it's already included sort of within net income. So you just have the debt payments here. So this is like 134, H134, and 134, that's a principal payment. So that is it, really. That's it. That's pretty straightforward. And when you're looking at your or doing this yourself as well, make sure that your error check on the balance sheet, which is assets equals liabilities plus equity, make sure that all balances. Now, if it doesn't, you'll get a -1 here. So as you see here, we're still balanced. All right, that concludes this video. In the next video, we're going to be talking about how we analyze the performance of Lucky Lemon Company, what ratios are available to analyze the performance of Lucky Lemon Company. All right, thanks for watching. See you next time.